Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Sometimes when a new law gets passed, it kicks off this whole chain reaction of problems that nobody really saw coming. Well, that is exactly what happened with the recent tax change, and it created this massive timing headache for U.S. multinational companies. So now the IRS is stepping in with a fix, and we're going to break down exactly how it all works. So here's the big question, right? How did a law that was probably meant to simplify things end up creating this huge timing mismatch for companies with operations all over the world? And more importantly, what's the IRS's game plan to sort it all out? All right, so this whole thing kicks off with one single piece of legislation. This is the catalyst for everything we're about to talk about. On July 4th, 2025, the One Big Beautiful Bill Act becomes law. And tucked away inside this, massive bill was this tiny little change to international tax rules. It repealed a practice that had been around forever, and that single change is what set this whole chain of events in motion. Okay, so before we can really get the problem, we've got to rewind a bit and look at how things used to work for decades before this new law came along. The companies we're talking about here are called Specified Foreign Corporations, or CFCs for short. Now, don't let the name throw you off. It's a super simple concept. A CFC is just a foreign subsidiary of a U.S. parent company. Think of, say, the German branch of a big American car maker. That's a CFC. So for a long time, these CFCs had this really handy option called the 1-month deferral. It was simple. It just let their tax year end 1 month before their U.S. parent company's year did. So if the U.S. parent's year ended December 31st, the foreign subs could end on November 30th. It was a pretty common thing, gave companies a little bit of accounting flexibility. And then, poof, the new law came in and got rid of that 1-month deferral. And that's where things started to get really messy and honestly, kind of weird. So to get back in sync with their U.S. parent company, these foreign subsidiaries suddenly had to create this weird 1-month-only short tax year. Just imagine closing your books for an entire year that's only 1 month long, in this case, December 2025, before you can start a new, properly aligned tax year on January 1st. Okay, this is the heart of the problem. Get this. In a lot of foreign countries, the tax bill for the entire year officially gets booked on the very last day of their tax year. So this meant a full 12 months worth of foreign taxes were suddenly getting crammed into that tiny 1-month U.S. tax window. It's kind of like getting your entire year's electricity bill on your January statement. It creates a huge but totally misleading expense. Let's really look at the damage this does, financially speaking. In this simple example, the company only recognizes 1 month of income for U.S. tax purposes, right? That's the $100,000. But it has to account for a full 12 months of foreign taxes. That's the $1.2 million. This crazy mismatch makes it look like they took a massive loss. And maybe even worse, they could lose out on claiming valuable foreign tax credits they absolutely should have gotten. So you've got companies looking at this totally bizarre, really unfair situation. And that's when the IRS stepped in with a proposed solution to fix this whole timing mess. So the fix comes in the form of IRS Notice 2025-72. And the idea is actually pretty simple. Instead of just jamming a whole year's worth of tax expense into one tiny month, the IRS is proposing a new way to properly allocate it. The whole goal is to smooth things out so the tax liability actually matches the income that was earned in that period. The IRS laid out this really logical 4-step process. It goes like this. First, you figure out the total foreign tax for the whole year. Second, you break that tax down by the different types of income. Third, and this is the absolute key, you apply a special allocation percentage to figure out how much of that tax really belongs to that short 1-month period. And finally, whatever is left over just gets carried to the next tax year, which is where it should have been in the first place. So, what is this allocation percentage thing? It sounds complicated, but it's not. It's basically just a simple formula designed to do one thing: match the income with the tax that belongs to it. You just take the income that was earned during that short little year and divide it by the total income from the entire foreign tax year. And that gives you the exact percentage of tax you should assign to that period. Simple as that. Let's actually put some numbers to this, using an example straight from the IRS notice. So the company earned 3,750 units of income in its 1-month short year, out of a total of 45,000 for the full year. You do the math, and that gives you an allocation percentage of 8.33%. So you take that percentage, apply it to the total tax bill of 7,200 units, and you get 600. That is the fair, correct amount of tax for that short year. Problem solved. The mismatch is gone.
But wait, there's more. This whole short year problem didn't just mess with income taxes. Nope, it also created another little wrinkle when it came to foreign currency.
See, there was this other rule that let companies recognize certain currency gains or losses over 10 taxable years. Sounds fine, right? Well, the problem was that this tiny 1-month period technically counted as a full taxable year, which just completely threw off the timing and all the calculations for this rule. So the IRS came up with a really simple, kind of elegant fix. They just changed the wording. Instead of spreading the gain or loss over 10 taxable years, the new rule says to spread it over 120 months. It's the same amount of time, obviously. But by using months instead of years, the rule becomes way more precise, and it doesn't matter how long a particular tax year is anymore. All right, so we've gone through the problem and the fix from the IRS. Let's step back for a second and look at the big picture here and talk about why all this really matters. So why does all this matter? Well, it boils down to 4 really important things. First, it stops an unfair outcome and makes sure companies can claim the tax credits they've earned. Second, it gives these multinationals a clear roadmap for how to handle this transition. Third, it actually shows the IRS is paying attention and willing to fix unintended problems when new laws pop up. And finally, and this is a big one for businesses, companies can rely on these rules right now, even before they're finalized, which gives them certainty for their tax planning. And all of this really leaves you with one big thought, doesn't it? This whole complicated mess grew out of what seemed like a pretty simple change in the law. And with global tax rules always changing and shifting, it really makes you wonder, what other hidden complexities are just waiting to pop out of the next big bill?